Well, friends, welcome back, and thanks so much for taking the time to push play. On the line is David McAlvany, the president and CEO of McAlvany Financial Group, a precious metals brokerage and money management firm, and a very lucid, intelligent man. David, thanks so much for taking the time.
Sean, pleasure to be with you.
Well, it's a real pleasure to have you. I was listening to your most recent McAlvany commentary, which features an interview with Giulio Galleroti about his book, The Power Curse. And I want to ask you a little bit about that conversation and the topics discussed. But I think before we get in that deep, what I'd like to do is call attention to a great video you guys produced called What is Real Money? And guys, David's YouTube channel is McAlvany Financial. And I want to play this clip for everybody just to set the stage, David, so they understand who you are and where you're coming from, because we're definitely on the same page.
Gold and silver became money over 2,600 years ago and remained so until recent times. In the history of money, we find an important, but today neglected, chapter on gold. Gold is merely a means of exchange. Through time, the marketplace voted two commodities as ideal means for exchange for their scarcity, durability, portability, and by market decree, a conduit of transferring value with integrity from one person to the next. Gold is not just a commodity or element on the periodic table. Through history, it's been kept by individuals and nations as a store of wealth, as a means of barter and exchange. It has all the qualities of money, and for millennia has been treated as such. Simply put, gold is money.
Now, guys, the reason I wanted to play that is not because it's new to you. Our listeners, David, are very well informed about what is real money. But what I wanted to do was set the stage for this conversation because you said something very important in that piece. First of all, I should point out that in that video, you talk very specifically about gold and silver being money and having been chosen as money going back 2,600 years. And you say, quote, a conduit for transferring value with integrity from one person to the next, end quote. David, the reason I wanted to hit on that is because our current financial system has become so Frankensteined and so detached from the simplicity of that statement that I wonder, could a return to gold and silver and a full reboot of our monetary system really save us, or is the system just too far gone at this point and those with power just have too much control?
I don't think the system is too far gone. There would be a high price to pay for significant structural changes. I mean, it's a little bit like asking the junkie if he's willing to quit. It will be very painful to go through a transition from being dependent on easy money. This is both a political problem as well as a fiscal and economic problem. If we were to transition, it would be a painful transition, there's no doubt. But that transition could be effected. And, you know, it's interesting going back in time, the conversation that I had with Giulio Galleroti in 2010. We've had a more recent one, but the one we had in 2010, his suggestion was that we probably won't go back to a gold standard, but we might go back to something that had the characteristics of a gold standard. And by that, he meant that it had to have disciplines. We have a monetary system today which is somewhat arbitrary and determined by the whims and fancies of central bankers. And actually, this is the point. With a gold standard, you have confidence in something that is not human. And with the fiat money system that we have today, that is exactly where your confidence is put, in a certain number of people who believe very much that they have the skill set necessary to create not only a healthy economic environment, but a stable monetary system. And, you know, they probably don't look at their own record closely enough to see, you know, whether they're getting an A grade on that. Our view would be that no, in fact, they're not getting an A grade in terms of price stability. But nevertheless, confidence is what's at stake. Confidence is what you do get with a gold standard, not dependent on men or women. And you know, I think that's where the gold standard shines. Actually, is it something that has endured through time, through the millennium, and through virtually every form of government.
You know, with so much to talk about as we see central banks really turning back to gold, we see nation states wanting to reacquire their gold held by the New York Fed. I guess what I wanted to ask you is, if we circle back to the Federal Reserve, they're answerable to no one, including the president. This private group of people certainly have hubris. I would agree with you there. But do you think it's also true that because it is a private organization, there are things going on that are malevolent in nature? by this private group of central bankers worldwide?
Yeah, it was Blaise Pascal who suggested that men never do anything so evil as when they're convinced that what they're doing is actually for a greater good. Now, I didn't quote that exactly, but that was the gist of it. And I think that's what you have with the folks in central banks. They believe that they're doing something good, and that by serving the greater good, they are in fact sort of moving the ball forward. I guess I start from a different philosophical position that the dignity of the individual and the value of the individual comes before the collective. And in fact, the value of the collective is based on the dignity of the individual. And what you find with most central bank policies today is an upending of that. They are serving that concept of the greater good at the expense of the individual. So, with financial repression, which is what is technically the term for keeping rates at the zero bound as they have and redirecting income from savers and households to your banks and financial intermediaries, and additionally acting as a subsidy to debtors, specifically government. This is, I think, where they believe that they're serving the greater good, and it is on the backs of households. So, from my perspective, from your perspective, from the man in the street, the common man's perspective, we would say this is not respecting our finances. This is not respecting our savings. This is not respecting the blood, sweat, and tears that go into creating wealth as an individual. The wealth of nations should not be set at the national level only, but has to begin at the individual level. So I believe philosophically I'm at a very different point or a different perspective than the central banks. I don't think that they believe what they're doing is malevolent. I do believe that they think that it's good. I just disagree with that.
Yeah, well, I agree with you there. I don't believe that what they're doing is good. It certainly isn't good. See, I just wonder who it is that they're serving, because they're not serving the people of this country by printing without recourse, without bounds. Let me ask you this. Is the thesis that owning physical silver and physical gold to protect us from a worst case scenario, is it also true that it can help protect our own personal financial sovereignty? Or again, is that just too simplistic a view?
I would agree. There's several purposes being served in the ownership of gold, in the personal possession of gold. Insurance is one of those things. The underappreciated part of a ship is the keel. It's subcutaneous. It's under the level of the water, and yet it adds a tremendous amount of stability and ultimately power. If you're looking at the hydrodynamics of a ship. What you suggest with sovereignty, I think, is also the case. You as a free agent, the ability to choose, the ability to act, how you choose is a second matter, left for moral theory and ethics. But the value of having the freedom to choose is certainly supported by financial autonomy from any particular system. And I do believe that gold and silver represent that. Not only, I think, should someone have gold and silver in their physical possession, but having it stored in different places around the world also gives you the opportunity to exercise that autonomy, even in the event of experiencing autocracy, and a governmental shift which may not be favorable to you. If you're a student of history, you can see the value of that. Certainly, we've seen border lines change throughout Europe on a more frequent basis than anything we've had to encounter in the United States. But for your listening audience, which I'm sure is more of a global audience, there is a basic governmental insecurity. You don't know who is going to be in power next, or what their agenda will be, or if you are in fact fodder for the agenda of that new power. And so maintaining autonomy and having some resources in many places around the world, I think, guarantee that.
Yeah, I agree with you. And what I'd like to do is ask you about the average American, the American populace. Clearly, gold is important to the biggest players on earth. What I would say, though, about our fellow Americans are probably 95% of the people out there in this country own no precious metals at all. And for most who do, they own it in paper form through paper vehicles in 401ks, IRAs, brokerage accounts. Most people don't own physical precious metals. And I often feel like the American public at large is like a fish in a fishbowl. And that big giant fishbowl filled with the American public it's all they know, it's all they've ever known, that we are the greatest, most generous, most powerful country on earth. Meanwhile, that big giant fishbowl with all those Americans is sitting in the middle of a huge room with Chinese and Russians and Indians and all sorts of nation states and all sorts of activities going on that the people in the fishbowl, the fish in the fishbowl, have no idea about. But at the end of the day, the joke is going to be on them, because this paper Ponzi system, 18 trillion in debt, 202 trillion in unfunded liabilities, a quadrillion in outstanding derivatives on Wall Street. When this system comes down, and I firmly believe it will eventually, when it comes down, the fish in the fishbowl are going to be in a lot of trouble.
Yeah, Sean, there's a couple things there that are important. Number one, what is the purpose of owning precious metals? And different people will come to a different conclusion on that. The paper products that you mentioned are very effective vehicles for a short-term trader. They do suggest a certain confidence and trust in systemic stability. To be able to trade a gold or silver proxy as a stock implies that the stock market is open, implies that volumes are robust, implies that there is a bid on the other side of that transaction to provide liquidity. These things aren't necessarily the case. And I think this is where someone who looks at gold and the purpose not being necessarily growth or trading profits, but rather as an insurance is going to focus on physical metals, because you want to take away those two primary risks of counterparty and custodial risk. And by eliminating counterparty and custodial risk, you have put yourself in more of a power position. And again, for some people, it's not important to eliminate custodial and counterparty risk, perhaps with greater confidence in the long-term viability of the financial system as it is today. I do think there is a place for those paper products, but as you suggest, there will come a day when people who assume the system will work as it always has may be very disappointed, And if in the back of their mind they thought they had an insurance policy with that paper proxy for the metal, again, they may be very disappointed.
Yeah, and you mentioned systemic risks. What are the biggest systemic risks that you see that threaten the current financial system? Again, I think that most Americans are woefully unaware of the systemic risks facing the system at large and certainly the dollar long term. What are the biggest systemic risks you see?
Well, let me paint a picture for you. This last weekend, I was skiing in the backcountry, beautiful, fresh powder, knee deep. And one of the things you have to be aware of in that context is basic instability. The more beautiful it is, the more you're enjoying yourself, the greater at risk you are, because you're talking about not only the pitch of the slope, but the weight that's on that slope and gravity being in force. All that to say, we have, given our system of debt, welfare statism, which has been a part of, and debtism, which has been a part of our reality for at least 40 or 50 years, we live with a certain degree of pressure and stress, natural instability in the system. Now, fast forward to what we've done very innovatively following the close of Glass-Steagall in 1999 and the proliferation of derivative products. What we have is 1,000,001 triggers for that instability. I think we're talking about a mountain of debt and a mountain of long-term liabilities, which are the basis of instability. But then what you're asking is a very relevant question. What is a trigger? And it could be anything. I think the greatest dangers are in the derivatives markets, and that is primarily because you have pride and overestimation built into the derivative structure. Mm-hmm. Derivatives are created to offset risk and lower total risk. But what the financial community has done with this idea of risk being lowered is they've applied moral hazard to that circumstance and gone ahead and taken even greater risks, knowing that they have insured against loss, using derivatives to do so. So you have counterparty risk built in, as you mentioned earlier, to the tune of about $1 quadrillion. It's a mind-numbing number, and frankly, was the reason why we had the troubles of 2008. gross speculation led to gross distrust between individual financial companies. And I think we're beginning to see that not even at the commercial level, but at the central bank level, where central banks are now saying to themselves, we don't know, we can't quantify the risks being taken by other countries. We think that to some degree we're being lied to with official statistics, and we want a greater degree of control. And so, in fact, whether it's the Germans or others, we have seen the addressing of custodial risk and counterparty risk with repatriation of gold. And I think that is in large part because they're skeptical. They're skeptical about who owns what has been rehypothecated, what has been promised out, what has been leased, loaned, what have you, encumbered. And in a moment of need, will they have what they need in terms of financial resources? It's a very good question to ask. And again, it circles back around to that issue of derivatives, one product being represented or sliced and diced into 10 products, and everyone thinking they own something, when in fact they may own nothing at the end of the day.
Yeah, and you mentioned rehypothecation. Let's just touch on that quickly. I'd like to get your thoughts on how bad you think the system is in terms of hypothecation and rehypothecation of gold. The work of GATA's Adrian Douglas before his passing suggested that in his estimation, and he quantified it pretty darn well, there's at least 40 to 50 paper ounces of gold in existence for every 1 ounce of physical. I think it's far, far, far worse than that now. That's research that goes back a good 4 years at this point. David, in your estimation, how bad do you think it is? Can you even begin to put a number on it?
The basis of my estimation is our family's experience in the physical gold markets for over 40 years. My parents started what is today one of the largest physical precious metals brokerage firms in the country. We've served tens of thousands of clients coast to coast and have placed at least $4 billion with clients through the years, starting in 1972. We're very sensitive to the ebbs and flows in the physical stock of metals. And I probably cannot improve on Adrian Douglas's numbers. 40 to 50 would be about right in our estimation. What we see more of is the tightness of supply when demand picks up just even a little bit. And there's been periods over the last 5 years where there has been an allocation, a limited allocation for every purchase from a client. For instance, I remember about a 30-day, 60-day period in 2008 where we had to limit client purchases to 1 kilo bar per day. The supply simply could not keep up with demand, and they were being forced on the exchange to convert 400-ounce good delivery bars into smaller bars to meet demand.
Wow.
So, there is a tightness of supply. I think that, fast forward from 2008 to the present tense, 2011, 12, and 13, as we've seen a decline in price, that has been exacerbated by a liquidation from the exchange-traded products. And I do think there is some degree of physical metals behind the exchange-traded products, in part because we have evidence from 2011 and 12 when those products were being liquidated, gold was flowing very quickly from London vaults to Zurich and from Zurich to China. This is particularly important on this point of physical metals because people believe they can go right back to the paper proxy, click their mouse, buy a certain number of ounces, and GLD will be able to go into the marketplace, or SLV for that matter, and buy an adequate number of ounces. On a good day, that's how it works. I think we have many days ahead of us that are not those kind of good, smooth process days where the public buys gold in its paper form and has gold set aside for it. I think they're going to be very surprised when they go to refill the coffers in GLD, particularly. 700 tons of gold is going to be a lot harder to find now than it was 3, 4, 5 years ago. So what I think we're coming up against here is tremendous pressure, supply-demand pressure, which can take the rate of change in the price of gold and make it a much quicker ascent than what we've seen in sort of the period of 2002 to 2011, 2012. So that's what I would expect. The last phase of the metals bull market, I would expect to see a much more aggressive rate of change.
Well, I couldn't agree with you more, and I would just say this about the GLD and SLV. Those financial vehicles, the custodians of which are JP Morgan and HSBC, may be riddled with a lot more malfeasance than meets the eye based on who the custodians are. But David, before we lose you, I do want to circle back briefly to the power curse. That was your recent McAlvany commentary, your conversation with Giulio Galleroti. You guys got into the problem of imperialism, and I just want to talk about that as it relates to the United States. And you noted, David, that the gains from imperialism cause you to stop doing the things that got you there. And then the imperialist nation crumbles from within. With 700 bases in over 130 countries and $18 trillion in debt, $8 trillion of which has been printed just since Obama became president, in your estimation, how much trouble are we in as an imperialist nation that seems to have moved so quickly and swiftly away from the ideals of the founders that made us great in the first place?
One of the bottom line conclusions in a conversation with Mr. Galleroti is this. Not only is it the fact that the bigger you are, the harder you fall, but his argument academically is the bigger you are, the more likely you are to fall. And he looks at 5th century Athens, he looks at 19th century Britain, he looks at a number of different mistakes that imperial powers have made sort of across time and in various parts of the world, and finds evidence that we tend to make commitments that we can't keep in an effort to sort of maintain the status quo, so that ultimately you begin to create instability by the very nature of those commitments. And so, yeah, The Power Curse, I think, is an interesting book from Galleroti. What we do in the weekly commentary each week is sort of explore not only current tense, where the markets are at, where they're going, but try to frame things so that listeners have perhaps a better depth and understanding or education coming into the world as it is, so that they can engage with it. They can thoughtfully appraise where we're at and where we're going. And so, the conversation with Galleroti is just one part of that.
Well, why don't we do this, David, to wrap things up? Let's just touch on currency wars. Let's just talk about this topic, which I know you've covered in detail. The dollar is very, very strong right now. I think it's surprised everybody. It's kept the prices of gold and silver low for those who hold dollars. But meanwhile, those who hold other currencies worldwide have seen the prices of gold and silver go up. Let's just talk about currency wars. How much longer can the dollar stay this strong? Is it inevitable that the dollar will always be strong, or is it inevitable that sooner or later the dollar will crash?
We're only strong relative to our weaker currencies. And what we see right now is every country around the world looking at global GDP as a pie. The global economy has been shrinking, but politicians want to maintain their original slice of the pie. With their constituents, it's very unpopular to see shrinkage in the economy and a rise in unemployment. So to combat shrinkage in the size of their slice of the global GDP pie, what they will do is debauch their currency. They will devalue their currency to give themselves a trade advantage, to remain competitive, more competitive, in fact, than anyone else in the world. So that is what we've seen initiated. We have played our part with QE1, QE2, QE3, and we think that we'll probably see another round of QE in the next year or so, as the Fed redoubles its efforts to sort of maintain stability in the financial markets. The current strength in the dollar really reflects the greater weakness in the euro, the Japanese yen, the British pound, the Australian dollar, the Canadian dollar. And so to say that we are strong, I think, is a misnomer. Only relative to those who are weaker than us are we strong. In absolute terms, I don't think that we are strong, and that's certainly a balance sheet appraisal. And I think we're going to continue to see greater weakness in the global economy, in part because of what's occurring with our trade balance. We are moving, at least on a temporary basis, towards greater energy independence, and I say on a temporary basis. We are importing less oil. We are importing less goods from overseas, And as our trade balance drops, the trade deficit shrinks, there's less surplus dollars that feed the emerging markets. So we'll continue to see stress and strain in the emerging markets. And those emerging markets then will be forced again to devalue, another round of currency devaluation. At some point, we're going to find, in terms of our own exports from the United States, the necessity to devalue ourselves. And I think we will be forced to do that within the next 6 to 12 months.
Well, that's not a good sign for those who haven't saved a little bit of their wealth in physical precious metals. That's my opinion. It'll continue to be my opinion until we see this thing play out. But as we have these conversations with so many wonderful guests, David, we like to say that we're documenting the collapse. I do believe that the collapse is in progress, and for the fish in the fishbowl, they may not see it. It's playing out in slow motion, but I definitely think we are documenting the collapse. David, could you tell people how they can learn more about what you guys do, and if they wanted to do business with you, open an account, anything like that? Can you tell us a little bit more about what you guys do and how they can find you?
Yeah, I think the two best things, means of getting to know us, if you want to go online and go to McAlvany.com and request What is Real Money. We'll send you that DVD at our expense. And it's a good opportunity for you to sit with friends or family and just, perhaps bring them along a bit. Use that as a tool to educate them about the history of money and the role of gold through not just our early history in the United States, but global history as well, world history going back thousands of years. The second thing I would encourage you to do is, for free, subscribe to the McAlvany Weekly Commentary. On Wednesdays, we'll send you a notice that the latest commentary is out there. We've done this every week for 7 years, and the guests that we've had on have been everything from global central bankers to politicians to it would be a who's who of people who are thinking about the world. Many of the people that we have as guests do not agree with us. We do not agree with them, but it certainly refines our understanding of the way the power elite attempt to sort of determine what our future course looks like. So I think those would be useful tools for you. The weekly commentary, subscribe for free, and we'll send you that notice each Wednesday. And watching What is Real Money, we'll send you a hard copy of that if you will allow us to. We look forward to doing that.
Well, that's terrific, and people can share that with their friends and family. I've long said, David, that folks that we know, those that we love, that haven't woke up, they won't be able to wake up until they choose to wake up. And certainly What is Real Money might help them along on that path. You guys can find out.
One more thing, Sean.
Sure, yeah.
My father's written a newsletter for the better part of 40 years called the McAlvany Intelligence Advisor. And at very high expense, I loved this July letter, this last year's July letter, so much. I think it was one of my dad's best written letters in 40 years. I went ahead and printed about 25,000 copies and sent those to people that I thought would benefit reading from it. We'll probably have to reorder some more if your listeners are interested in additional copies. But request the July letter. We've redone it as a special report. It addresses a lot of the things in the gold market and gives you some perspective. My dad was around in the 1970s. He certainly understood in real time what the strengths and weaknesses were, what the PR agenda against gold was in the 1970s. And he elucidates that. He makes it very clear where we're at and where we're going with a historical perspective. He lived it. He breathed it, being in the business at that time. So I think it would be not only an encouragement for those of your listeners who are interested in the precious metal space, but one of those tools, again, perhaps as a means of passing along to friends and family members. It really, to me, also encompasses my father's heart as well as his mind. He's a very bright man, but he's also a man of deep compassion, and all of that is bundled into this special report. So I would suggest that would be one other way of getting to know who we are as well as what we do.
Very cool, guys. You can find out more at McAlvany.com, and by all means, subscribe to their YouTube channel, which is McAlvany Financial. Our guest has been David McAlvany of McAlvany Financial Group. David, thanks again. Thanks so much for your time.
Thank you, Sean. Have a wonderful day.
You too. Guys, thanks for listening, and thanks for checking us out at sgtreport.com. Real news 24/7. Bye-bye.